Hello and welcome. The foundation for a successful retirement income plan requires that all the pieces work together well. Welcome to this series, the Tax Reduction Strategies for Living Well. Just want to let you know, myself, Realistic Economist, are not affiliated or endorsed by the Social Security or IRS or any government agency. This program is strictly designed to be educational in nature. This multi-part program is based on my books, The Road You're On, and The Bad and Ugly, The 8 Retirement Income Risks. It's also based on IRS rules and regulation, and will include some excerpts from my programs presented at William Patterson University here in New Jersey. A little bit about me. You can read, part of your handout packet will be my bio, a little information about myself. But I just want to let you know, this will be the most straightforward, nothing hidden educational program that you'll ever receive. Why? Well, number one, I'm certified by the National Social Security Advisors. I've authored 7 books. And there's no free consultation, come into the office gimmicks. There's no free meals. There's no sales pressure. What you're going to get is really just straightforward education. I have designed this program by eliminating and reducing taxes, and that's how you're going to create a greater income. But I divided it into 4 sections. And the nice part is you can start, stop, and replay any section. Just if you put it on pause, don't leave it there too long because I do get tired from standing. We have a Q&A by email, which is very important as you go through the topics. You have questions, we can answer those questions and get them resolved quickly. Education rules, we've really, again, it's divided into 3 parts. The video classes will be divided into, this time we'll probably have 4 segments, not the 5. It'll include numbered emailed handouts. The second part will be a copy of my book. You have the complete book. It's a PDF copy. It's The Bad and Ugly, The 8 Income Retirement Risks, which you can refer to as you go along with the program as well. Last but not least, I think what really becomes critical, and it really helps tie a lot of your learning together, is we do either a pro forma tax return and an income report. And the nice thing about it is that you can log right into my computer as we're talking on the phone, and you can see it live. So if there's a tax strategy or something you're looking at, does this make sense to do this way or that, you can actually see it live in front of you and to see if it makes sense, if it's the right way to go. It's pretty straightforward. The videos are really designed to be followed in sequence. So it's the 1, 2, 3, 4. Each sequence is approximately about 15 minutes, and it's really done primarily to help keep you awake and also give my voice somewhat of a break. If you need to ask questions, my email is on the handout as well, but it's joe@realisticeconomist.us. Today's program is the Tax Reduction Strategies for Living Well. People ask me the question, Joe, what can I do to lower my taxes? And the answer is actually there's lots that you can do, a lot more than most people think. And a lot of the taxes that we pay are basically paid because of what choices we make and not necessarily because it's mandatory. What I want to do is to maybe make it a little bit clearer and help folks understand, why do you think we pay way too much in taxes? And what I find, as I'll give you a little hint, it has to do with the way we think. And it's kind of strange to say that, but I call it mental math. So sometimes when we do some quick math in our head, we make these tax decisions, or ultimately we come up with numbers that really have no basis in reality. So let me give you this quick story. In 1913, my grandfather put about $20 away in a trust, for his future grandchildren. He was fortunate to have the trust administered by one of the oldest law firms in New Jersey, and they were responsible to maintain the trust principal, make sure it grew, any taxes or anything that had to get done with it. That was a responsibility. And the nice part is the growth rate over those 84 years, it did a full 20% growth. So we had some really good investment returns in here. So at that rate, the account would have grown to $74+ million. Now, given the complexity with tax laws and the difference of the rates, some years the rates was as high as 90%. What we did for the illustration, we used 45% as an average. The law firm charged a $100,000 legal fee, and that handled accounting, investment decisions. That was their fee they got, but they got the fee at the end of the period. Now, there were 4 grandchildren, and the question is, how much did each receive? Let's take a look. Well, the total value we said was $74 million. It's $74,657, $495. That was the total value. We knew their taxes, so we took about 45% of that number for taxes, so that took about $33 million. Obviously, when we do the subtraction, it left about a little over 40, almost $41 million after taxes. They had to pay the legal fee of $100,000, so that just left a tad over $40 million. Not bad. So we divide that by the 4 beneficiaries, and it doesn't have to be a real math whiz to figure out each beneficiary got a little over $10 million. Not bad. And I got to say one thing, I was very fond of my grandfather even without the inheritance. Now, when we do the true math and get away from the mental math, we're going to find a very interesting happening. The total value of that account at the end of those 84 years was only $115,000. Once you subtract the legal fee of $100,000, that left a fund balance of $15,556, and that basically went to the 4 beneficiaries, and each one got about $3,892. Now, if you want the exact numbers, I have them. You can email me. I will send them to you. But what folks don't realize is that each year, as the fund pays out its taxes, it changes the value, and it didn't get that a larger number. So it's important to realize very, very simply, math and money are very different. And when we try to use the two, we get into trouble. Yeah, you have to understand that there are many things that are not simple to understand. They're not complicated, but we can't use our mental math, and we can't use a lot of the thought process that we use for other problems when we look at sometimes problems with taxes or concerns with taxes. What I did is I listed a few taxes that really, really hurt. 1, tax on our Social Security income, tax on your interest and dividends, tax on mutual funds, tax on capital gains, tax on your IRA, tax at your death, and I call it's a New Jersey trap. And we're going to talk about some mystery taxes in that and how they relate to things sometimes you just don't even see. This particular section, we're going to concentrate a little bit on the tax on our Social Security income. Now, what's important is you have to become a more informed consumer. So you don't get caught in these traps. It's too often people just don't know. They just think it's the status quo. We'll do it this way. I referred to in the book that as you're reading it, like these South chain gangs, they walk in lockstep. People just do that because that's what everyone else is doing, and they realize that it's actually going into a tax trap. There was a tax law change just recently in 2016, and I think that's super critical. It talks about how they're going to reallocate. It's really cool. It's called the Congressional Reallocation of Assets Program. They commonly refer to it as CRAP. And the funny thing is, when I do these classes live or these programs live, some people catch that right away. Other people are just looking around like, what's everybody laughing about? And you can tell who is paying attention or not. But what we're going to try and do is understand a little bit about taxes. Now, reducing taxes, or you have to learn, number one, not only about taxes, you have to learn the rules. Learning the rules is important, but how do you following the rules? You have to stay on top of the rules and make sure your family understands the rules. That's important when we talk about IRAs. Now, what's important as we go through all these programs, means testing is going to really wipe out the middle class. Now, we talk about means testing in our Social Security and our Medicare programs because means testing simply means they're going to take more and more of your dollars to pay for benefits. We go into that a little bit more detail in those particular programs. You really need to get prepared. We're going to be experiencing some increases in taxes as we go into retirement, as well as increase in our benefit costs in Social Security and or Medicare. Now, what I see during tax season, when I help prepare returns, I'm a volunteer tax preparer for AARP, is simple. Most folks are overpaying their taxes every day. And the interesting thing is, even with the people that have professional advice, sometimes I find it hard to believe. So it was difficult, but it took me a while to figure out the answer, and we'll review that in a second or so. When I do a live seminar, the nice thing about that is I can ask questions and get an immediate response. I'll ask a question is, how many people have an accountant do their taxes? And, maybe half of the folks raise their hand. And I follow up with a question, and I ask, at this point, how many receive a call from their CPA on April 16th telling them what they can do to save taxes for the coming and future years? And interestingly, no one raises their hand. I did have one person one time, a bunch of years ago, and I said, wow, what kind of an account do you have? He said, it's my nephew. So for most frequently, and you can answer the question of yourself, you very rarely get a call from your CPA right after tax season and said, oh, Mrs. Smith, I think if you do this and this and this or that next year, you'll definitely save your taxes. It's just not done. Now, it took me years to figure out why. I couldn't understand why it wasn't done, and I realized something, that's not what our accountants are trained to do. You've got to develop a strategy. So by arranging your fares properly will mean more money in your pocket. And how you get more money in your pocket is you're paying less income taxes. So if you give less to the IRS, it's obviously staying in your pocket, and that'll help, especially when you retire, you're on a fixed income. We're going to take a look at actually Social Security. It's now considered taxable income for many retirees. Back in 1935, FDR, Franklin Delano Roosevelt, said something that I think is profound. I promise the American people that you will not be taxed on Social Security. It is not intended as a tax resource. I ask, what happened? Well, in 1983, Congress discovered that Roosevelt had died. Took them a while. I know they're a little slow down there in Washington, but they did figure it out. In 1983, the Greenspan Commission, that's our former Fed Chairman Alan Greenspan, was appointed, and they made a decision to tax wealthy Americans. Now, you're going to hear this time and time again. They're going to tax wealthy Americans. The wealthy are going to pay more. The wealthy can't afford to pay more. Who are we going to tax? We're going to tax the wealthy. You'll hear this over and over again, but let's take a look at what Congress considers wealthy. In 1983, Congress changed the law that allowed up to 50% of Social Security to be taxed. Then they went in 1993, 10 years later, and they decided they're going to now raise the tax. Instead of up to 50% of Social Security being taxed, it's 85%. So a lot of times folks will tell me, well, you know, it's the Democrats or it's Republicans. And I kind of joke with them. Back in 1983, I'll ask, you know, who was the president? And they'll say, you know, some of the sharper folks will say, oh, it was Reagan. And I said, yes. And I said, Reagan is a Democrat or was a Democrat or Republican? They said he was a Republican. I said, okay. In 1993, they decided they were not going to go out, they're not going to hit, you know, they weren't hitting these wealthy Americans hard enough, so they went and they hit them with now an 85% of Social Security being taxed. I go, who was president in 93? And they'll say, oh, that was Bill Clinton. I say, was he a Democrat or Republican? And obviously he was a Democrat. So what you're going to find a lot of times is it really makes no difference, Democrat or Republican. So when folks tell me it's one party or the other, we're looking at it here and we're seeing something totally different. Now, what I want to show you is this. You'll pay no tax on Social Security if you're an individual filing, if your total income, including half of Social Security, is less than $25,000. So basically, if you're getting $10,000 from Social Security, half of that's $5,000, and a $15,000 pension, that's $20,000. You're not paying any tax on your Social Security. Now, when you go into or you earn a little bit over $25,000, including half of Social Security, so what that means is simple. You're getting $10,000 from Social Security, $5,000 is taken into that number, and then you're getting $20,000 in a pension. Then you're at $25,000. Now half of that Social Security becomes taxable. If you go to as long as you're within 25 to 34,000, you're okay. You're at the 50. You're at the 50% level. Once you go to higher income, once you hit the 34,000, 85% of your Social Security is considered taxable income. When we look at the married filing jointly, if the couple is earning income from pension or whatever, investments or IRAs, and half of their Social Security adds up to less than $32,000, then they are paying no tax on their Social Security. If they hit $32,000 but less than $44,000, then half of their Social Security income is considered taxable. Now, when it's put into that, when you take half the Social Security, it's put in with the other assets, and it's your tax rate is determined from the total. Once you hit the $44,000, 85% of Social Security benefits become taxed. So what I try to explain here is this. When they made the law back in 1983 or 84 when it came out, they did not index those dollar amounts to reflect any inflation. Now, what's important about that is in 1983, a single filer at $25,000 was fairly well off. They weren't a millionaire, but they had a higher than average income, so they could have been considered wealthy Americans. So what they did is they never indexed that number. They kept it at those numbers, and just as inflation through the years went by, you found more and more people falling into that trap. Now, I refer to it as a mystery tax. You're really no better off than you were years earlier, but just for the fact of inflation, you wind up paying more and more tax on your Social Security, but not getting any extra benefits for it. Now, I ask a question when I do the live programs, is the tax on our Social Security an optional tax? And most folks say no. And unfortunately, that's where we get into some of the confusion. It is an optional tax. It's depending where your income is coming from that determines the tax. How they look at it, it's pretty straightforward. This is what they use for determining tax on Social Security. They look at something called provisional income. They take your Social Security income, and it's on line 20A if you have a tax return handy. If you have one of the other courses, one of the handouts is a tax return. Pensions are line 16A. IRAs, 401ks, retirement accounts 15A. Interest-bearing accounts 8A and 9. Mutual fund distributions, even if not used. So technically, you get a distribution from a mutual fund. It's a taxable distribution. You may not get any money, but you've got a distribution on paper. That's included in that provisional income. And municipal bonds. Now, a lot of times people ask, well, municipal bonds are tax-free. The answer is yes and no. It depends. Are they really tax-free? Well, folks will give you different answers. The answer is yes and no. Really, municipal bonds are like a chameleon. They change. Prior to collecting Social Security, if you buy, let's say we're located here in New Jersey, if you buy a New Jersey state bond, you're paying no federal income tax and no state income tax. But that changes when you become retirement age and you're collecting Social Security. What happens is they bring that number in, the dollar amount from your municipal bond, into it's off the tax return, which is line 8B, and now that determines if your Social Security income is taxable. So here's my question. If it's on your tax return, and it's changing the amount of Social Security, are they considered taxable? I would say yes. Now, they also, just for the folks in New Jersey that are listening, it's considered income for if you're on property tax relief, which is a program we have for the 65-plus folks to freeze their property taxes. So these are the numbers that are brought into taxing your Social Security as well as the property tax relief. That's the end of video 1. Let's just do a quick review and see what topics we went over. We reviewed a little bit about Joe, that it's a straightforward educational program. There's 3 parts of the video. It's the book, the tax return and income reports, and ultimately tying it all together. There are 4 videos in this series, and there's lots you can do about taxes, reducing them. We talked about my grandfather and the trust fund, doing mental math, a partial list of the onerous taxes. We talked about the Congressional Reallocation of Assets program, why most folks are overpaying their taxes, FDR's promise, a tax on Social Security income, and municipal bonds are changing. Hi, I want to congratulate you on completing part 1 of your video series. I'm excited. I hope you take advantage of the Q&A that's involved in each particular section. Very important to clarify and keep your questions answered quickly so you can go on to the next section without having any open questions that aren't answered. So please do that on the Q&A. Thank you for watching this part and looking forward to seeing you at the end of section 2. Thank you.